If you're a short-term trader, obviously the duration of time for these types of trades could be anywhere between 1 day to as much as a week or so. Swing trading is about a week or more in terms of trade duration, and I forgot to mention that. But for short-term trades, you'll be using the 4-hour chart for your trade premise or your directional bias. And then on the 1-hour chart, that would be your trade management or mid-level time frame. And then your 15-minute chart would be utilized for your timing for entry and possibly looking for early reversal signs that your trade may be petering out and it's time to take profits. For day trades, obviously, you can see it's the 1-hour chart. It'd be your highest time frame. You would be managing your trade on the 15-minute time frame, and your 5-minute chart would be utilized to enter. Now, it's not to say that you can't use a 5-minute chart on the short-term swing and position trades for entry. Okay, I'm giving you the framework for at least having 3 time frames across the spectrum of your trading, and how you break down market structure over these 3 specific time frames for each individual trading model will give you, again, the building blocks to flesh out what you need to see in terms of directional bias. Okay.
Down close candle. After a run up, we retraced, went down inside this gap. See that? This area here, when it trades down towards this gap, this is the draw on liquidity up here as well, near term. So above these relative equal highs, we have what? Buy stops, or buy side liquidity. So I'm thinking that the algorithm is not letting price go lower. So it's going after everyone that's been profitable going short. We retrace, going down into an imbalance, and the market rallies above the down close candle. Does it support price? Yes. Time of day is important. So I'm watching when price comes back down into it here. I'm taking the opening price, extending it out in time. When that occurs, then I know I have a setup where I can go long. But I want to go into the time frames a little lower than the hourly chart to give me a little bit more context, because we do have a low that has a higher low to the left and a higher low to the right. So that makes this what? Intermediate term low. This retracement here, this might be trading into an imbalance, which is what I'm teaching you to look for. But the overall market structure is it's likely to go higher and aim for a run above these highs. Notice this high and this high. It creates what? Relative equal highs. Retail-minded traders are going to see that and say, oh, this is exactly what the textbooks say about resistance. So it's acting as a ceiling. Price acting like a ceiling. What should they expect to see price do? Go lower. So here's that level where the buy stops are, or above it rather. Here's that hourly down close candle, which is a bullish order block. Notice the down close candle is made up of 2 candles on the 15-minute time frame. Price moves away from it, goes above it right here. Does it create an imbalance here? Yes. That is how you determine your high probability bullish order block. It must have the imbalance coupled with the down close candle and the underlying narrative that it's likely to go higher to reach for buy side liquidity. Period. Okay, that's it. There is no engulfing candle does this. Forget all that. You don't need that. Okay, it's the gap plus the down close candle plus the idea that it's likely to go up for buy side liquidity. That's it. So we're trading down into this imbalance here, but now we're doing it at the time of day after the equities open at 9:30 in the morning New York time. So volatility, the initial move is technically the incorrect move going into the opening at 9:30. So this is like a Judas swing. So think about what we're seeing here now. The market's likely to go up above this level here to take the buy side because the market's unwilling to go lower. The algorithm keeps pressing higher, 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 higher. It retraces down into the 9:30 opening. This is that fake move. Don't chase this, and don't chase going higher right before the equity's opening at 9:30 either. So you have to take a step back and figure out what is you're looking for. Well, I'm looking for a discount market. Low to high. I'm below 50%. Yes. I'm inside the order block. Yes. The equity's opening has happened. I'm bullish and it has traded lower. So public is going to be thinking what? It's resistance. It's going to keep going down. To what? There's your support level because it bounced there last time. So they're going to think there. Well, it doesn't do that. Down to a 5-minute chart. It hits the order block and then rallies. What is this? What's your favorite value gap? Market trades back down and overlaps that gap between this candle's high and this candle's low. This right here, that right there, that is one order block with a lower time frame order block and a fair value gap. You can take that trade if you know what you're looking for and you understand bias, narrative, and where the liquidity matrix is likely to lead to later on, which is drawing up above this red level here. Buy stops are above here. So if they're going to send the price higher from here and start rallying, that supposes that there's someone that got on board long here. Where would their ideal exit be? 6 points higher? 10 points higher? No. They're going to want to take it up here, where there's willing buyers with buy stops to protect their short positions. So when the market trades above that level, the buy stops become market orders to buy the market, which floods the market with liquidity. For those that have bought down here, they can sell to those willing buyers at a higher price, which they're waiting for down here and waiting for that price rally to go up. Now, as the market goes higher, the expectation is, and my expectation was, I want to go long in here and reach for this high. This was my entry idea, that it's overlapping, filling in that gap, and it's an order block here with a higher time frame order block there. So there's an hierarchy. Higher time frame to a lower time frame with the idea framed on it's going higher for buy side. I have an intermediate term low forming. And now, this, when it fills in that gap, once that happens, what did I teach you last night? This becomes an intermediate term low. This low should not be taken out. Once it starts rallying, it should not come back down here. What else did I teach you? If price is going higher, down closed candles should support price. Well, it trades above it here. This down closed candle is high right there. It trades above it on this candle right there and starts going higher. But then look what happens. It starts to go back down. It might go down here and stop me out. I'm not thinking that. I'm looking at this down closed candle thinking it's only going right back down into this down closed candle to accumulate more long positions. So smart money traders are going to be buying more here, like I did. Rallied. We have down closed candles. We went above it. I'm not worrying about the market as long as it doesn't take out these two down closed candles. Trades down, gets real close to that, but does it eat up and go through that range of these two down closed candles? No, it just retraces down into what? An imbalance. Why? So smart money can buy again, like I did. The market rallies again and goes into the buy side liquidity. Order block, trades through it here. Get long. Fair value gap. Order block. Retracement. Get long. Order block. Imbalance with the fair value gap. Trades back down. Doesn't even come back down into the order block. This is classic. It generally doesn't like to go all the way back and rebalance when it's that close to the profit objective. So the algorithm only has a small little retracement inside the fair value gap, so you would be a buyer. Just at that candle's low. And it runs right to the target. Now, I know some of you just don't trust me. These are TradingView execution errors, and I'm going to log in to TradingView and actually show you by highlighting these actual arrows. But I'm going to take you down into the charts. Now, all the way down into a 30-second chart. So you can see the grouping of where I actually entered with this logic. Okay. Now remember, intermediate term low is down here. This should never be overtaken until the objective is reached. So all of this price action leg here is, I trust that it's going to keep going higher as long as the down closed candles keep price above it. Above what? Above the down closed candles. That's going to be supporting each new leg higher. The market should not retrace back down below those. So what am I saying? For trailing stop losses, you do not want to take your stop loss. If, say you bought it down here like I did, and your stop was below the middle of this candle. That's mean threshold of the bullish order block. So I don't think it's going to go down below that once I'm entering. Then it starts to rally and goes above this candle's high. My stop loss must remain below this candle's low, because it can dig into that candle because it's going to act as an order block. Then the market rallies away, comes back down, retraces. Now if I put my stop loss inside this area here, I'm stopped out prematurely. And chances are you probably wouldn't have the wherewithal to get back in. You'd think, well, I just lost out on potential profit. I made a little gain, but I'm afraid to get back in now because it took me out. That's infancy. That's because you don't know what you're doing. Everybody was like that. I was like that. But you grow out of it. If you do the same things I'm teaching you over time, it's built into your understanding and it's ingrained in your understanding about price delivery. The market rallies above, takes out these two down closed candles. Now the stop can be raised from whatever would be below this down closed candle. Now it can be raised below this down closed candle. Because the idea is these down closed candles are one order block that should not be violated if it's bullish. If it comes down and breaks the low of these down closed candles, well, there you go. You probably did the right thing by getting stopped out, because it might be failing and going lower. How's that for logic? You're not going to be perfect. I'm not perfect. Even though you see these arrows on the lowest candle here, and it goes out to the exit here, right above that,